Hi and welcome to today's Arch Capital update. Hope you are all well. We are now into February and the year is starting to get underway. Nice start to the year in markets, particularly after last year. We've seen a positive, very positive January and a decent start to February with the interest rate announcement today. Expectations rates will go up again. Most of that seems to be factored into the markets. No surprises there at the moment. But what I wanted to talk about today was a tool we use a lot. You might have seen this. If you haven't, please reach out. We can do this on Zoom or in a live meeting. And we find it really powerful. It's a modelling software, particularly when markets are a bit jumpy, but in good times and bad. What this does is it puts in the amount of money that you might have investable, super, non-super. It talks about your retirement age, how much you're living off pre-retirement and how much you expect to live off post-retirement. So those who are retired know what that's like. It's pretty daunting to retire and look at it and think, right, I've got no more income coming in, this capital has to get me through my lifetime, and of course we all don't know how long we're on the planet for, so we have to expect that it's going to be for as long as possible, hopefully well into our 90s, maybe even for those who want to tick off the 100 or more. So that's a long time for that money to last. It is quite daunting, particularly in those sort of mid-50s ages where you're still working and starting to contribute and starting to think, well, how much will I spend in retirement? So that's what we do. We really help with that planning and really that transition to retirement, which is difficult not just financially but mentally as well, to work out, well, what am I going to do and how am I going to live and what's it going to look like? So this tool is used in many situations. For those who are retired, it can provide a lot of comfort to say, hey, the markets were a bit flat last year, but hey, that means that I'm still going to be okay. My money's still going to last well. This chart is just an example, but it has capital running out at 94, but that's expecting the same level of expenditure. And one thing we always say is, well, if you're living off a certain amount when you're 65, 70, you're probably not going to need quite as much when you're 90, but you might, but it's unlikely. So this chart obviously keeps, if that expenditure reduces in the late 80s, it obviously extends, and this also doesn't factor in any government support or downsizing or anything like that. So a really helpful tool. If you'd like to set up a time, set up a call, a Zoom call just to run through your situation, please reach out, please email, contact the team and we'll set up that call, or next time you come in for a meeting. The other thing I wanted to talk about today was there's a change in the super rules, which you might have heard us talk about, but now you can, from the age of 67 to 75, you can contribute to super without meeting the work test. So in the past, it's actually if you're 65 and older, you had to meet a work test, and it restricted the ability to add more money to super, but that's now gone. So if you have money outside of super, there's the opportunity, but there's also a strategy that we've been talking to clients about, and you might have heard us talk about it, and we'll talk about it if it's applicable, but it's called a withdrawal recontribution. So a withdrawal recontribution, I got it. So what that means is that you can take money out of your super fund and put it back into super tax-free. That's all within the rules. So why would you do that? Well, within super, there's a death tax. There's if you pass away and there's money still in your super funds, in the first instance it can pass to your partner, your spouse, tax-free, or a financial dependent. But if you're the only survivor and it passes through to your estate and your other beneficiaries, whether they're adult children or other people in your estate, they can pay 15% of the taxed element of your fund. So what does that mean? Quick drawing. Let's say a super fund has $1 million in it, and half of it is taxed and half of it is untaxed. Now the tax component gets in the super fund from your taxable contribution. So when you're working, all those components are called taxed. The untaxed are the contributions that you make when you make a tax-free contribution, a non-concessional contribution, all these words, but basically if you're putting in 100,000, 300,000 into the funds at some stage, here it's your super contributions going in over time. So unfortunately, when you pass away and the money goes to a non-financial dependent, this component gets taxed at 15%. So if you've still got $500,000 in this taxed component, that's a lot of money. So as we all get older, that starts to become something we think about and go, well, do I really want my estate to pay that 15%? You know, that's $75,000, not $150,000, $75,000. So that's quite a lot of money. So what you can do, you can actually take money out of the fund. So you can take out $330,000 and it comes out proportionally and it goes back into here, into the untaxed component. And it just reduces this taxed and untaxed component. It just makes the untaxed a higher percentage, obviously, than the tax component, and therefore might reduce that tax down from $75,000 to $40,000 or lower. So it's worth considering. A bit of technicality there, but it's something we're talking about with everyone as we're reviewing super funds and saying, is that something worth looking at? And in most cases, it is. For some, it's not a significant issue. They've got more untaxed anyway. So when we meet next, or if you've got a question about that, please reach out. So 2 things today: planning, getting comfort around longevity of capital and income rates, and a really interesting strategy that we can run through with you. Thank you for listening in. A bit of a longer video today. Hope you have a nice day. Thanks.